Welcome to this video on common chart patterns. We will explore the shapes that price often forms on a chart and what they tell us about market dynamics. Chart patterns are repeating shapes that describe the actions of buyers and sellers, providing a shared vocabulary for traders. It's important to remember that these patterns show tendencies, not certainties. The triangle pattern forms as price tightens between two converging lines. This represents a balance being reached between buyers and sellers, with the range narrowing as both sides hesitate. A breakout often follows the triangle. There are three common types of triangles: symmetrical triangles, which narrow from both sides, ascending triangles, which have a flat top and rising lows, and descending triangles, which have a flat bottom and falling highs. The flag pattern is a brief pause within a strong trend. Price moves sharply, then pulls back gently, usually against the trend's slope. A flag often resolves in the direction of the prior move. Flags happen when early buyers take profits during a pause, allowing new buyers to enter at slightly better prices. The original trend then often resumes from this point. The head and shoulders is a classic reversal pattern featuring three peaks, with the middle peak being the highest. A neckline connects the lows between the peaks, and a break below this neckline often signals a trend change. The inverse head and shoulders pattern works in reverse at market bottoms. It forms three troughs, with a lower one in the middle. A neckline connects the highs between the troughs, and a break above it often signals a trend change. A double top forms when price hits the same high twice, indicating buyers failed to push price higher. Double bottoms work in reverse, signaling a possible rise. A break below the middle low or above the middle high confirms the pattern. Remember that every pattern fails some of the time, even well-known ones. External events like news and big moves can instantly break patterns. A pattern simply shifts the odds slightly. It does not guarantee the outcome. Patterns are most effective when combined with other tools. They gain strength near major support and resistance levels and on higher time frames. Avoid trading patterns in isolation, as they are weaker on their own. In summary, chart patterns are a valuable vocabulary for understanding market behavior, but they are never a guarantee. Focus on how these patterns reflect buyer and seller dynamics, and use examples like triangles, flags, head and shoulders, and double tops to inform your decisions.